Hello, good evening, everyone, and very warm welcome to tonight's webinar. Or it could be good morning to some of the visitors, the attendees here with us tonight, because we have audiences from Singapore as well as from US and many other parts of the world. So my name is Richard, and I'm your host tonight. Please allow me a few minutes to introduce our community to you. So let me go to the slides. All right, so my name is Richard and I'm from OTCS, which stands for Online Traders Club Singapore. We are a non-profit society formed in 2005, and we are a community of traders and investors, mainly here in Singapore. And to me, OTCS stands for a place where we network, share, and learn, and we do it through a series of workshops and webinars and courses and our library. For workshops and webinars, we aim to hold about 6 to 10 a year, and it is free for our members. To attend, we used to hold physical workshops, but since COVID, we have moved entirely online and we made it free for everyone to attend. And for courses, we aim to have about 2 to 5 a year. And this photo you see here is one of our last physical in-person events that we had in the Singapore Stocks Exchange, where they sponsor their auditorium for our use. For courses, we aim to have about 2 to 4 a year, and we usually do a group buy with the trainers to bring down the prices for our members. As for our library, we have over $6,000 worth of resources, and we can lend it out physically to the members here in Singapore. So if you're in Singapore, you can check out the PDF on our website to find out what are the resources that we have. So again, OTCS is a place where we network, share, and learn, and we do it through a series of workshops, webinars, courses, and our library. The normal price to join us as members is 120 Singapore dollars a year, but for a time limited period, it's only $60. And at the moment, because we are still holding webinars, it is entirely free for anyone in the world to join us. To learn more about OTCS, please visit our website at onlinetradersclub.org. And if you're here for the first time and have not already joined our Telegram channel, please search for Online Traders Club in Telegram to join it so that you can be kept posted of our upcoming events and updates. It is a channel, not a group chat, so it will not be noisy. Alternatively, if you prefer to receive it as an email, please go to our website to join our mailing list. And not forgetting that while we were running physical events, I want to give a special shout out to our OTCS crew, the unsung heroes, fellow members of the club who are helping us behind the scenes to run the workshops. So thank you very much. You know who you are. And now for the very important slide called the disclaimer. You are responsible for your own profits and losses. The speaker's opinions are their own and does not represent OTCS's opinion. OTCS, its office holders, associates, sponsors are not responsible nor liable for your losses. And OTCS events are for educational purposes only and should not be construed as advice. And when you're in doubt, please seek professional help. So with that out of the way, I just want to highlight that if you have questions later when John is sharing, please feel free to type them into the chat box that you see on the screen. It will be on the bottom right of the screen if you're using a desktop browser, or you may need to scroll up or down if you're using a mobile device. So please feel free to type in your questions along the way. And at the end of his sharing, I will ask the questions on your behalf to John. All right, so with that, brings me to the topic of tonight, which is zero DTE break-even iron condors in SPX. and it will be a complete strategy sharing. Now, I need to mention that this strategy can be a little advanced. So if you are a beginner in options, you will probably need to do a lot more homework. And for those of you who are experienced in options, I believe tonight will be a great eye-opening session and sharing by John, who is so generously willing to share with us exactly how he trades his break-even iron condors in SPX. And he's came all the way from Norway to share with us in this webinar, thanks to the technology. So can I hand over the stage to you, John? Yes, I see you. You will need to unmute yourself.
Okay.
Excellent.
Now everything should be fine.
Yes.
Let me also just get my slides in here.
Thank you.
Share screen. Let's hope we will. It's not this one. I have the same one in 2 tabs. So let's just get the right one in. There we go. You see it, I think.
Okay, let's give it a few more seconds. Yes, I see it.
You see the slides. Okay. Well, first of all, thank you very much for inviting me to this session. I must say I'm a little humbled giving a presentation like this, but it's also very challenging and interesting to be able to share what you do, because usually you get so much feedback and questions that may help me do my own stuff even better, I think. So I'm going to present the zero DTE break-even iron condor strategy, and I'm gonna tell much more about it later. Just to say a little bit right now about this strategy. It is my favorite strategy. I have traded this for 2 years now, and it has worked quite well for me. And I love this way of trading. It's a market neutral strategy. It's not taking directional bets, rather taking bets on the market staying within certain parameters. And it's a strategy which actually has more losses than wins. We will get back to that, but there are small losses. So many, but small losses. And still, it has been consistently profitable for me so far. So that's just a little bit highlight about it, and we will get into the details later. I thought I would do this presentation in 3 parts. I would start with just telling a little bit about my own trading journey and my own background. Then I will describe this strategy more in detail, and also share the results that I have had with it after doing it for 2 years. And then finally, I will go more into details about how I trade this strategy, how I manage risk, etc. But let's first start a little bit with my background and my trading journey. And maybe a couple words about myself first. I'm actually presenting for you now from a place called Stord, an island on the western part of Norway, just by the fjords and the sea just outside here. This was actually my grandparents' house, and my grandparents actually have a strong connection with Asia. They were missionaries actually in China in the 1920s and the 30s. So there is actually a strong sense of China in this house. I'm 60 years old. I live in Norway. I work as a communication manager in a company called Schibsted, which is the largest media company in Norway. We own the biggest newspapers in both Norway and Sweden, but also online marketplaces in all of the Nordics, so including Finland and Denmark. And have also had built up a lot of similar businesses in Europe, but those are now spin out. And I worked for this company now actually for 30 years, but in very different positions. I started as a journalist in Aftenposten, which is Norway's largest newspaper. including 3 years as correspondent in Asia. I lived in Hong Kong from 1997 and 2000 until 2000, so I traveled quite extensively in the region at that time, and that's what. And I still have let's say, a strong heart for Asia. That's me. What I do. Then I want to share a little bit, just also my trading journey and how it has gone in phases, because I think I'm pretty much sure I'm not the only one that has seen both, let's say, very positive periods in trading, but also, let's say, negative and flat, etc. And on this slide, you actually see the percent how this portfolio that in options trading has developed over time for me. Compared to the market. The blue one is my portfolio, and the red one is Nasdaq, the yellow is SPX, and the green one is Root. And why I want to share this is that, this if you look at this graph, and let's take let's take the first part here in 2020. And if you look at my blue graph, you see this was pretty much a huge shock. When the COVID hit and the market fell, I took a big loss and basically lost half my account. And it took a long time and I did not really take part in the return immediately either. Well, this was a huge, let's say, tuition to pay or a huge learning experience, because the reason was pretty easy. I had taken just too big risk. I was trading a lot of weekly iron condors and credit spreads at the time, and they suddenly got very much into negative. I was spending too much of the account on these trades, and they got very quickly into the negative territory when the market fell suddenly, as you'll remember. And I just thought that it would turn around and stayed on with the position instead of taking the losses, and the losses just get bigger and bigger, and you see the results. I lost half of my account, and it really was a learning experience. And I know many traders have had similar experiences where having the account more or less blown up. So this was something that I really had to rethink what I was doing, and wondering if I should even continue with this trading. Then I had a long period of more than a year, I would say, finding my way. So you see during this 2021 until the first part of 2022, it was basically a very flat development of my account. And these are not only the strategy I will describe today. These are different strategies. This is the total portfolio I had. And I was doing okay on the 0 DTE, actually, and that one was positive. But again, I was not always doing well on weekly or longer term strategy. They had a tendency to be hit by the gamma and get into more negative territory and would draw down the gains I had in 0 DTE. I also had some 0 DTE strategies I was testing that didn't go too well at the time. So this was pretty much a long learning period as well, trying to find my way. And then since May last year, it's been going very well. I would say I have been able to double my account and finally caught up with at least 2 of the 3 indexes. And this is primarily due to the strategy we're going to talk about today. But it's also due to the fact that I learned a little bit about that maybe weekly trading, trades were not for me. I was not as disciplined with those type of trades, and maybe I should just skip them, more or less. And this is also what I've done. So I've had less of these, let's say, drawdowns due to other types of strategy. And I think, I'm sharing this only because I think it's a similar journey many of us have, right? That we are trying to find our way, trying to learn, and we need to actually, I think it's necessary to actually have your account blown up or have these struggles to actually be developing as a trader. And I'm not, I'm not. I don't have a huge account myself. I'm doing this as a hobby in the evenings, and I'm lucky enough to, since I live in Norway, the US market opens at 3:30 p.m. in our time, so I can basically start this activity after work. I don't have to struggle to combine it with work hours in my day job, or as you in Singapore, having to do this late after bedtime. So it's in many ways an ideal time zone to do this in. And I there are many things that fascinates me about. Well, let me start this first. After these activities, I've learned a few times about myself as a trader, and the first one is that I do not like big losses. And then I guess you're saying, yeah, but who does? Well, I guess nobody does, but we have different tolerance for how big risk we are willing to take. And I learned through all this process that I really do not like strategies that give me the very bad days, even though the strategy may be profitable overall and in the long term. I don't have the big tolerance for that. It makes me uncomfortable, nervous, etc. I also learned that I really have no edge in predicting the market direction. There are option traders who are really good in this. They have all kinds of technical analysis, able to look at resistance and support and all the types of indicators in technical analysis, and are able to actually do successfully with directional trading. I've learned that I do not have an edge in that. I'm not. I've tried some different stuff, and it hasn't really been successful for me. Maybe I will be one day, but at the moment, I do not have an edge in that. I also learned that also through those experiences that I said, that I'm actually more disciplined with 0DTE than longer durations. And the reason is that with longer durations, you have the overnight risk, right? Where a position might very quickly change from being in a position positive to suddenly being negative. And it's not as easy with stop losses either, because, it might blow past your stop loss on these overnight changes. With 0DTE, for me at least, I put on stop loss right away. I always have that. And I'm able to trade more disciplined. This is me. This is me and my personality. And that's also why I found that, this strategy I will share today, it really fits my personality and my risk profile. It may not be for you, because we have different risk profile. We have different edges, what we like, what we don't like. But for me, I found that this kind of fits me, my personality and my way of thinking, and how much risk I'm willing to take. And then one slide about why I actually love trading and why I like to spend time with it. And this is actually because it also, in many ways, helps me learn more about myself. It helps me be more disciplined. Because I think in many ways, trading is a fight between two parts of my personality every day. The emotional John and the rational John. The rational John knows that he needs to be disciplined in trading. He needs to have the rules. He needs to stick to the rules and, trade according to the rules all the time and accept the losses and look at expectancy, etc., etc. The emotional John, and I think you all know that part of yourself as well, will be tempted by greed. He has this idea that he has a gut feeling, that he feels that the market will turn around or it will do this and that. And just one more, he is willing to take a risk that he knows that maybe he shouldn't, because he wants to win back the losses or whatever. And in many ways, the option trading for me is a little bit fight between these two parts of my personality, and it helps me to be more disciplined over time. And I love this type of this kind of tension within my own personality. And I'm guessing that some of you may be able to recognize this part. All right, so let's move to the 0 DTE break-even iron condor and my result, the second part. But I thought I would start with I assume that most of you know a bit about options trading, a bit about how it works, and I'm not going to give a very detailed explanation, but I think let's take at least a couple of expressions or terms that you need to know. The first is SPX. This is the options product on the Standard & Poor's 500 index. So all the trading in this strategy that I'm sharing today is on SPX. This is an European style options product, which means that it is cash settled. There is no risk of assignment. If you are in the money when the option expires, it's settled in cash on your account. And that is definitely a benefit compared to, for instance, trading SPY, where you have the risk of being assigned shares. It's a very liquid product. I mean, there's a lot of, compared to many other options product, and that's also a huge benefit because it's easy to get into positions, but it's also easy to get out when you need to get out, and the spread is usually quite small. There is expiries every day now since last spring. There is a new expiry every day, so you can actually trade it every day. So basically, it's identical to the SP 500 index. Then you have the expression 0 DTE, which only means 0 days to expiration. So that's the options that expire the same day as we are trading them. And this has become tremendously popular. This graph I stole from some website showing how big percentage of the total option trading now is in the same day expiry, and it's really increased in popularity a lot during the last year or so. Let's also just explain what an iron condor is. Probably most of you know, but let's just take it. An iron condor is an option strategy where you combine two credit spreads. So you sell an out-of-the-money call one side and buy a call further out as a protection. And then you at the same time sell an out-of-the-money put and then buy a put further out. In this example, I need to look at the other screen to see what it says, but I'm selling a 4145 call, buying the 4175, and then selling the 4095 and buying the 4025. So this iron condor will stay profitable between those shorts or a little bit beyond those shorts, but once you go beyond those, it will suddenly get into negative territory, and the total risk you are having on this trade. So the width is 30 on the SPX. So which means you always multiply by the 100. So the total risk is $3,000 on this trade, minus the $210 you are collecting as premium. So that should be $2,790 is the total theoretical risk on this position. And then we use stop losses to reduce this. So this is the iron condor. Now let's just give a description of the 0 DTE break-even iron condor and how this works. And there are many ways of doing this. I'm just going to explain how I do it during this presentation. I just give a basic definition now, and then we'll get more into the details. So the idea here is to sell a 0 DTE iron condor at between 5 to 10 delta, collecting the same premium on both sides, or as close as the same as possible, and doing this at multiple times during the day. at different market levels. Then after that, you immediately set a stop loss on each spread separately at the total of the premium. I usually add 5 cents on it. So if we take this 200, this example I gave you that collected $210, I would set first the stop loss on the call side for 210 plus adding the 5 for good measure, so 215 on the call side, and I would set the similar stop loss on the put side at 215. This means that if you lose on one of them, basically you are still keeping the premium. So you basically, in theory, you lost those 5 cents. In the end, a little bit more because the slippage, etc. So that's why we call it the break-even iron condor. In most cases, you will only risk being stopped out on one side. So that means that essentially you are quite close to break even if you lose on one side. But this is a very tight stop loss. And what I also do then, in my way of trading it, is that I do tighten the stop losses during the day to manage the total risk of my positions, but also to secure some of the profits. And I will get a little bit back to how I do that. But that's also part of how I trade this, that the stop losses are not static necessarily all the day. I might tighten some of them for different reasons. I set the stop losses on the spread, but I do change it to only be on the shorts, either during the last hour of trading or when the long has no value anymore. Because at some stage, if the longs are far out of the money and there is really no bids for them anymore, and then you don't want them, then you want to take them out of equation and only put the stop loss on the shorts. So I typically do this during the last hour, sometimes earlier, if I see that the long positions no longer has any value. So I have traded this strategy now for 2 years, and I keep a very detailed log, so I am also able to kind of analyze my results in very good ways. I've done over those 2 years 2,582 trades, and that sounds a lot, but of course when you divide it down to 24 months, it's a little bit more than 100 trades per month and 25 trades per week or something, 25-30. This strategy really depends on keeping the average losses much smaller than the average wins. And in principle, the loss should be close to zero, hence the name break-even iron condor. In reality, there is some slippage happening, and you will have some double stop losses where you have stop loss on both sides. You will have some bad fills, so it will be a little bit more than that. But for me, in my trading, the average win has so far been 2.3 times the size of the average loss. And that is how it is possible to have this strategy as a profitable one, even though there are more losses than wins. So let's move on a little bit on some of the numbers here. Just a minute here. Over those 2-3, there are a couple of numbers that have been very stable, actually. The first is actually win rate. The win rate has stayed surprisingly stable during all those 2 years at around 40%. It's been at times 38, 39, 41, 42. Right now, the total is actually 40% win rate, 60% loss rate. And then you can, of course, this will give a positive expectancy when the average wins is 2.3 times higher than the average losses. There is another number that's also stayed very stable, and that's the double stop losses. So these are the trades when the stop loss hits maybe the put side first, and then later on the call side. Of course, on this, then you are not even close. Then you are no longer close to a break even in the result on that trade. So this over my 2,582 trades, there 3.7% of the trades have been double stop losses. And this number has also stayed surprisingly stable throughout the whole period. And just a couple of things here, because people measure this in some different ways. When I talk about trades and win rates and win rates and loss rates, I look at the whole Iron Condor as one trade. And I'm mentioning this because there are some people in the Facebook group that Tasty Trade Options that are calculating in a different ways. They look at the Iron Condor as two trades, the call credit and the call side and the put side. My numbers are based on looking at each Iron Condor as one trade. So if one side loses, it is actually a loss on that Iron Condor. Also, all my numbers are based on the net profit, so that is after the commissions and fees have been paid. Just to make that clear. And I have two ways of, what then is the profitability? I have two ways of looking at it. One is, which is the one I prefer, is actually what is the average return per trade. And that is as a percentage of the capital risk for that trade. So meaning the buying power you are putting up. And on all those trades I've done, the average return has been 0.45%, which may not seem a lot, but this is a daily trade, right? And when you start analyzing it and looking at a monthly level, the numbers really can get quite big. Another way of looking at this is what is called the premium capture rate, where you take the net profit as a percentage of the total premium collected. In my case, that would be 10.1%. I don't use this one so much because the premium capture rate doesn't really consider the risk you are taking. So I prefer to look at this first number, and this is the one metric I'm using when I try to compare different zero DTE strategies. And I think compounded, that would be more than 200% on an annualized basis if you kept bringing the profit into new trades. So it gives quite a bit results when you actually analyze it. I'm just gonna show one more graph on this, and this is just the money numbers, and I'm not giving the actual numbers here because I'm not sharing my account size such. But this is how the dollar amounts have kept giving profits on during this period. And in fact, I've had only 2 months that have been negative. That was January, actually, in 2022, and January this year. Other than that, all the months have been profitable with this strategy, which, of course, I'm quite happy with. I think there is not many strategies that will never have a losing month. So that's a basic overview of the results and how I measure them. Now let's go a little bit into how I trade this one more specifically. Let me also say that I trade this in some kind of a discretionary way rather than fully mechanical. I have strict rules for my stop losses, what I put those on. But other parts, I'm a little bit more flexible on how I do it. So that means I'm not mechanical in the way that I sell the Iron Condor at 12, 1, 2, 3, and target $180 in credit or exactly 7 delta or whatever. And I'll try to explain a little bit more how I think about it. But there are many others who trade similar strategies that are more mechanical. And I will, if you're not a member of it already, I really recommend the Facebook group Tasty Trade Options. I am a member of several Facebook groups on options trading, but I really must say I love this one. It's very good sharing knowledge. People are really, giving. There's a lot of interesting comments, interesting posts, and you really can learn a lot for the others. And in this group, you will find a number of people who trade similar strategies to the one I'm describing. For instance, Tammy Chambliss, who was giving a webinar for you earlier, she is trading something that is being called multiple entries iron condors that, let's say, compared to mine, is much more mechanical at specific times. She also do it in a credit targeting way. So she's targeting, I think it is around $150 on each side. So basically, she's selling at much higher deltas than I am, doing it very mechanical. And look her up in that group if you are curious, because there are different ways of doing this, and they are all kind of similar strategies in the way that they try to be break even with very tight stop losses. But I do not have the same mechanical style that some of the others have. The whole idea, for me at least, is to have many small trades throughout the day. I started out with fewer ones, and once I was able to grow the account, I was thinking, should I scale by adding more contract? But I rather scale by adding more trades. Usually, I enter the first trade just a couple of minutes into the market. Depends a little, but if it stays kind of flat for the first minute or two, I will just enter one. If it's going suddenly very much up and down, I might skip it. This first trade can benefit from the IV crush that typically happens the first half hour. But of course, it's a little bit hit and miss, because quite often the market jumps in one direction during this first hour, and then of course you will hit the stop loss. But I've learned that too, and you don't so often have the double stop losses on these ones. That's the first one. Typically, I will add new ones every 30 minutes or maybe 45 minutes, but at least 30 minutes between each trade. I don't want to put them on too close, because I want them to both let the theta work on the first ones, and also kind of come in at different levels, so to speak. I try to be very careful during the last minutes of the trading day. I try to be very careful about because things can get really volatile before the close, and it's not uncommon to see big jumps. So I will very often, usually not enter any trades during the last half hour. Sometimes I do if I feel, let's say, overall safe with my other positions. But the whole idea, as I trade it, is to have a number of small trades throughout the day. And I might actually sometimes get up to 12 to 13 trades in a day. But I do never have all those trades open at the same time. So I will get a little bit back to that, how I look at the risk. But I will not just have unlimited number of trades open at any times. But often you are able to, some of the trades are closed out during the day, and then you are freeing up capital to try new trades. But many small trades is the criteria that I'm following. For entering, I usually choose a width of the legs that is 25 to 35 on SPX, which means that I'm theoretically risking around 2,500 to 3,500 on each trade. Usually the delta will be between 5 and 10, and I usually try to collect between $100 and $200 for the whole IC, so both spreads. I will typically be in that. I rarely do trades where I collect more per contract. I enter the whole iron condor in one operation, and this is a typical discussion in our Facebook group. Are we legging in, or are we doing the whole in one operation? Some people really believe in legging in, and of course trying to take benefit of a small move in the market so that they can get a better price on both ends. The benefit of legging in is that you can ensure that you get the same premium on both sides. Personally, I prefer to just do the whole iron condor in one operation. And the reason is that I found that, even if you try legging in, you might miss the direction. And yes, you get the same premium on both sides, but your position might already be in the minus when you have entered the second one because you missed the direction. And the same can, of course, happen when you do everything in one operation. It can suddenly move in one direction or another. But since I don't really think I am good at picking direction, I just find it easier to do the whole one in one operation. And sometimes I am not hitting completely to get the same premium on both sides. But I think the end result is not very different than from compared to if I try to leg in. Is how I'm thinking about it, at least. I try to wait for the time when the price of SPX seems to flatten out a little bit. Not being too theoretical in this, but if the market is just pushing up minute by minute, I will wait for the next trade until I see at least, typically if I see 2 or 3 5-minute candles that seem to be flattening out, then I'm thinking it might be a good time to enter. Just wait for it to stabilize a little bit. And this is, of course, extremely important, is to always set stop losses. This is also a discussion. Some people actually think that it's better not to have. And it is, of course, when you set stop loss, you do, of course, get into the situation quite often that the market hits your stop loss, your position is closed, and the market turns around, and you would have been profitable. And most of the trades we do here that we lose on would have been profitable in the end. But, when we're risking 2,500 to 3,500 per contract per trade, I at least don't really want to be in that situation. And the market can move extremely fast sometimes. And this is the big risk with zero DTE, that the market can move so fast that what is a positive position can be a very negative position very quickly. It takes sudden news of some sort. When Donald Trump was president, a tweet from him would suddenly make a position look completely different because the market just turn around in one way or the other. So I think stop loss is just necessary. Then there is the discussion about what type of stop loss order should you have. And this is also, people do it in different ways. You basically have a stop limit order, and you have the stop market order. The stop limit order, you set a trigger price and then a limit price. And if it hits the trigger price, it will try to close within that limit price. This is, of course, this gives you some guarantee for or target for the price you will get out of it. The problem with the stop limit order is that sometimes if the market moves very fast, it may just skip and jump over the stop limit order. And then you are on your own, right? If the market runs against you, skip it out and keeps running against you, you can be very quickly in a very bad position. The stop market order on the other side just closes you out at whatever is the market price at that time. So you will get out. You have the guarantee that you will get out, but you do not have the guarantee for which price. And you may, again, in this situation where the market makes a huge jumps in one direction or another, you may get a very bad fail. But you are getting out. I actually use a combination of these two, using what is called the OCO. One cancels the other functionality. So what I do is that I set actually two stop losses that are connected. The first stop loss is the stop limit order with the stop at the total premium plus this 5 cents that I described, and the limit typically 0.2 further out. And I don't know, I don't have the statistics. In 95% of the cases, when my trades are stopped out, it is this stop limit order that is triggered. But then I also set stop loss further out as a stop market order, typically 0.15 further out from the limit price. And these are set up them with this functionality called OCO. So meaning that if one of them triggers, or the other one is cancelled. So this stop market order, I don't really want to be hit, but it is like a last line of defense if my stop limit order is skipped. This has worked quite well for me, I would say. It's a little time consuming to set up the stop losses in that way. But I've had a few bad experiences of stop limit orders being skipped and the position really coming into bad negative territory very quickly. So this, and after having that, I was discussing with other traders, and I came up that this might be a good idea of good way of doing it. For exiting, getting out of the trades, the main rules that I use, I usually don't let them expire. Usually, the exit is either that the stop loss is hit, or I will set a take profit at the shorts, close to shorts, when they are at 5 cents. This is just because I just like to get the risk out of the table, basically. In most cases, I could just have let them expire. But I prefer to do this to just reduce the buying power and reduce the risk. And I've had enough experiences that even if a short position is at 5 cents, the market can suddenly turn around and all of a sudden you will end up with a stop loss on it. So that's why I prefer to close out at 5 cents with the shorts and just be done with it, even though it cost me a little bit money. And the one benefit is that the remaining longs can then be reused later in the day. And which is means that I don't have to buy the longs at that time. I'm just reusing the same that I already have on. So I can essentially, in the end of the day, often sell strangles instead of iron condors because I already have the long positions there as a protection. I will also sometimes close positions early to ensure profit. That would typically be this first trade of the day. If it hits and suddenly it's those trades can sometimes get very profitable within an hour, and then I will just close out to have at least some profit to start the day with. Just makes me feel better. I will try to quite often. I said I add this 5 cents, but I will very often tighten the stop losses rather quickly when the theta started to decay, just to at least ensure the break-even point. So if our example 210, I said that I would put a stop loss at 215. So maybe after half an hour, 1 hour, I would adjust the stop loss to be like at the 2, for instance, just to make sure that it's closer to break-even. And then I will also throughout the day adjust some stop losses. And I will get a little bit big back to that, but and tighten them up depending on the total risk in my positions, but also sometimes again to ensure that I have a profit. If I were to 10 example, suddenly the call side price is at 50 and the other one is at 40, then I might tighten the stop loss on both sides to 100, and then I'm actually insured a $100 profit, but I'm still on to get the full $210 or $200 profits. So I will do that sometimes. This is maybe the most important for me in how I trade, is that managing total risk is just the most important during the day. I don't have purely mechanical rules for this, but it really, my risk management determines how many positions I will have on. So what I always try to ask myself is, what is the worst that can happen today in my current positions? If the market just jumps 40 points up or drops 40 points, what will happen? How much will I lose? And this, I try to always ask myself that question, because the biggest enemy of this strategy is if you have sudden and large moves in the market. And sometimes that happens, that the market may jump 20 points in a minute. Or drop 20 points. Those are the worst situation for this strategy, because we have very tight stop losses. The stop losses will be hit. So I'm trying to think what will happen, what will be my situation. So to explain a little bit more how I do this, if for instance I have early in the day I've had 4 trades, and all of them hit the stop loss on one side, on, let's say, on the call side. What do I then? Then I will probably be very careful about entering new, because what if the market suddenly turns around dramatically? Well, then I will be in a position with 4 double stop losses, which is not good. So what I will typically do that, because if that happens, it is because the market has moved up, right? So I will start tightening up some remaining stop losses, maybe tighten 2 of them very much and leave the others as they are. And I will just wait a little bit extra before I put on new trades to let the theta and the K move on, and let's get everything a little bit more under control. I'll be careful with new positions. I try to especially be aware of the possibility of the double stop losses, because they are the ones that add up losses. So this, I don't have it tight, but I would say that I don't really want to be at real risk of double stop losses in more than 4 positions, I would say. So I would try to avoid that, and be careful and when I enter new trades. It could be that I said I'm not doing directional trading, and I'm not. But I will sometimes add a call or put credit spread just to adjust the total delta. And this will again be this typical position that if those 4 stop losses have been hit on the upside, and the market suddenly turns around, and I see that I'm getting close to double stop losses on 3 and 4 position, then I'm, my existing position really will benefit if the market goes up. Then I might be put on a call spread just to reduce the loss if the market keeps moving down. So I will hedge sometimes like that. And I try to make sure that I'm never risking more than 1 to 2% of my total capital on a single day. I would say I usually target more 1 than 2, but I think it's a good rule to look at. So I'm always kind of assessing my current positions on a regular basis, and use stop losses and whether I will enter new trades or not, to kind of adjust the total risk, because and it's essentially the core question here is, how many positions am I risking a double stop loss on? And then just when I have a lot of positions, it can be a little tricky to keep the overview of the different trades. And so what I do, I use Thinkorswim from TD Ameritrade. So there I actually group the trades. So I have the different groups down: daily trade 1, daily trade 2, daily trade 3. So I just when I enter trade, I just put the new position into a new group. So I think I have up to 15 of these. So they are kind of separated in Thinkorswim. Then I do my trading log in Excel, where I put a lot of data, but I keep adding them in my trading log immediately, all my positions and what happens to them. So they are basically corresponding to the groups in Thinkorswim. And at the end of the day, when some of these short positions will close at 5 cents, my risk is also going down. So then I will gray out the positions that are totally out of risk. And this is how I keep an overview of the trades, because it can be a little tricky. So it's the combination of the grouping in Thinkorswim and having my Excel sheet with my trading log on the other screen. So I essentially use 3-screen setup. I have my trading log on this laptop that I'm looking at now. I have the big screen where I also have the main window of Thinkorswim, and I have a third screen where I have like a more adjusted window with some VIX and some other metrics that I try to follow. So let's talk about some of the risks with the strategy, because and what can happen. The biggest risk is, of course, that you can have the stop losses hit on both sides, double stop losses. And as I told you before, in my trading, this has happened in 3.7% of the trades, and that's kept pretty simple. And that's, of course, always a frustration when it happens, but it will happen every now and then, a few times every month. So for me, it's more a question of, as I explained, to look at the total risk and ensure that I don't have too many positions that are at risk. The second that can happen is bad fills, and this can happen if the stop limit order is skipped, right? And the market is moving very fast. It hasn't happened very many times to me, but it does happen every now and then that you then get into a stock market and a bad fill where you actually might lose a couple of $100 extra on a contract. I don't have statistics of how often it happened, but it doesn't happen very often. The third thing is an interesting with my stop loss strategy is that it might happen that the stop limit and the stop market order trigger at the same time. I had explained that this can happen in where the price suddenly hits the stop market order and suddenly skips the stop limit, suddenly hits the stop market and immediately moves back and also is closed in the stop limit. So both orders are triggered at the same time. That's always been a bit confusing when it happens, because you always have to realize what it is. But what the result of this is that what you are short, you are suddenly long. So actually, if this happens because the market drops suddenly and it keeps dropping, this new long position that I have might actually make the whole trade profitable. Well, what I do in those situations, these are not what I want to happen, and it has happened to me, I think, only 5 or 6 times. So I basically just close it as soon as I can. And I think 2 or 3 of those 5 trades actually ended up as profitable because of this effect that I was suddenly long what I was short, and the market kept moving the same direction. But my thinking around this is that I just try to get out of it as soon as I can. The fourth is that, you need to be quick to set the stop loss order, set it immediately. But the market may actually make a sudden move before you have got around to set it. And then I guess you just have to take the loss when that happens. Shouldn't happen very often, though. I just want to mention one tool that I'm using called 0DTE-SPX.com. It's a guy in the Tasty Trade Options group that Konstantin, I don't know, Julian Konstantinescu, I don't know if that's the correct pronunciation, that made this tool. And the one thing that I really love with it is that you have the price of the live price of the SPX, you have the blue one, you have the wicks, you can have the estimated move on this day. But what I really love is this black curve that is graph that is showing the pricing of all the out of money options that day. So it basically shows how the theta decay is working throughout the day. And it can be very interesting to see. Sometimes you actually might see this one. It should normally go down regularly during the day, but you might sometimes suddenly see it moving upwards, which means that the IV basically is growing, and it doesn't always move along with VIX either. So I find it is a very nice tool, and sometimes we'll see if this out of the money put prices increase. That might be a good time to actually put on a new position. One very important learning for me is to keep a trading log. I think it is absolutely crucial because it's very hard to keep the overview of all this how your strategy is doing without it. So it can be done in many ways. I have an Excel sheet I use where I put in the strikes, I put in which of my strategies it is connected to, how much premium I collect, when I close, what is the total risk, gross and net profit, and more. So then I have some pivot tables that I use to analyze this data, and this is why I can tell you that I had 2,500 trades, and they had a 0.45% average return, etc. So there are different ways. There are external services that helps you to do this too, but I think and it can be done in many ways. But log your trades. That's I think it is very hard to know if you're successful if you don't have a detailed trading log. So I'm gonna go in for landing here. I realized I have talked for a long time already. Again, this is how I trade this strategy, and I'm not saying this is the right way for everyone. This is and there are other ways. And again, I recommend you to follow this Tasty Trade Options Facebook group because there is a lot of sharing of the different ways of trading these type of strategies. On the positive side, for me at least, is that I avoid the mostly avoid the very negative days. Of course, I have losing days. I have days where I lose more than I appreciate, but it is not the profit and loss is not as volatile as other strategies I have tried, at least. And for me, that is with my personality, it's a good thing. I prefer a strategy that's not as volatile. There seem to be many that are able to make quite consistent profit in today's market with this type of strategies, including the ones that Tammy Chambliss is following. And you can make different variations depending on the risk. I think the disadvantage is that it is rather time consuming. At least how I do it with many trades throughout the day. And for you in Singapore, it will be throughout the night. And my style also requires quite close attention to risk management, and not everyone has the time for doing that. Also, because there's so many trades, you also pay a lot in commissions. And as I said, the numbers I've given you before today are the net profits and net results. But actually, 30% of my gross profits have gone to commission and fees, which of course is a tax in a way that I really don't like to pay. But that's the disadvantage with so many trades, and I think a disadvantage with zero DTE trading in general, that because so many trades, you end up with a lot in commissions. I just want to close up with 2 points. How I want to evolve. 2 things about how I want to evolve my own trading as I move forward. And one is I'm hoping to identify some way of diversifying strategies. Today, I do have 2 or 3 other strategies, zero DTE strategies that I follow, that I do on a regular basis. I'm not going to go into those, but actually my hope is that I could find a set of strategies that give some diversification, because the break-even iron condor will not work in all conditions either. And so I've been thinking about how can I best compare the strategies, and I think that this average return per risk capital is the best. Where I told you that the break-even iron condor so far for me has given an average 0.45% return. And this is just a graph I'm making now on where I'm trying to compare the different strategies I have. The blue one is the break-even iron condor. This is for the last months. The yellow one is my total, and the total will be pretty close to the blue one, because that is where I put most of my capital. But one thing you see here, right, is that there are some pretty big changes in how volatile the strategies are, especially the gray one shows how strategies can go up and down. So my idea and what I would like to try to research a little bit is how could I get up with let's say a set of 3 or 4 strategies that somehow balance each other, so that the yellow, the total, would get as stable as possible. I haven't worked much on this, but I hope to somehow find a way to look at it in that way. That would be a small set of strategies, where a break-even iron condor probably will still be the main one, but where I would have a couple of other strategies that was kind of balancing it out, so and giving a more stable total profit. The other I want to do now is also really start with back testing. There has been a lot of new tools, and I haven't personally done much of back testing yet, but this is my ambition now to really start doing that and verify my own results with that. So I think that's the next step for me personally in this, and that's basically what I had. I have written a couple of articles about the zero DTE break-even iron condor on my personal webpage, sandvand.net. So feel free to check those out if you want. And I will probably do a new write-up, because how I trade it does evolve over time. But and feel free to mail me also if you have any questions or comments. And yes, that's what I was going to present, and I see I spent a full hour here.
Yes, thank you very much, John. Wow, that was an excellent condensed session of the essence of break-even iron condor that you've been trading for the last 2 years. Thank you so much, John.
Welcome.
Well, shall we continue with the Q&A segment?
Yes.
Okay. All right. So now, thanks all attendees for staying with us so far, and for those of you who have just joined us, this is recorded and it will be posted on YouTube. So please look for Wealth and Joy YouTube channel, and you will be able to see the webinar there, and you can revisit the points that John have covered. And also, please don't forget to like, share, and subscribe if you have benefited from this session. I think this 1 hour has been very intense, right? A lot of information has been compressed into it from his 2,500 trades in the last 2 years, almost every day. So if you have questions for John, please type into the chat box that you see on the screen. It will be on the bottom right of the screen. And if you're on a mobile device, you will probably have to scroll up or down to look for the chat box so that you can type in your questions. So while the questions are coming in, John, may I ask you some of my personal questions that I have first?
Sure.
Okay, great. Now, in no particular order, all right? I think you're like the Bruce Lee, you and Tammy Chambers is like the Bruce Lee, right? Because Bruce Lee said that he does not fear a man who has practiced 10,000 kick once, but he fear a man who have practiced one kick 10,000 times. I think you are a quarter your way through the break-even iron Condor. Yeah, so well done there. Well done. And thanks so much for sharing with us. Now, my first question, in no particular order, is this. Do you skip or delay any trading due to news? Like, for example, sometimes there's an FOMC day, or sometimes there's a news event at 10 a.m. Eastern time. Would you, delay or you skip that day?
I tried on FOMC days. I always thought that I will give it a try, and it didn't go so well. I was always ending up with losing. So the last FOMC day, I really decided this time I will not be tempted to trade, so I did not trade at all. What I've seen on this zero DTS SPX.com page, you actually see it very clearly on those days that this black line until 2 p.m. in America, we're showing the out of the money theta decay, that there is absolutely no decay on those days. Normally that will happen throughout the day, but on those days until 2 p.m. there is absolutely no decay. And then, of course, the market typically makes some wild moves up and down the first few minutes afterwards. So I think I'm trying to not trade on the FOMC days. And I might sometimes, I always check the news, and sometimes there are some important news coming half an hour into the trading day. Then I might prefer to wait until after that half hour to do it. Yeah. What happened here now? I don't hear anything.
Can you hear me?
Yes, you are. You seem to have been so shocked by my answer that you disappeared.
Sorry, I got dropped off for a few seconds there. So let me move on to the next question. Now, if the trading day is half day, for example, it's a Christmas Eve or something like that, would you still take the trade in the morning and end half a day?
Yes, but with of course obviously fewer positions.
Oh, so then you will not open new positions if the market is closing at 1 p.m. Eastern time. Then you will stop entering new trades at 12:30.
Yeah.
Okay,
typically.
Understand. Just curious, do you think this strategy will work with XSP instead of SPX?
I'm not sure. Of course, it's very tempting to. I would hope it would work, but I think there's one big issue, and that's the liquidity. But I haven't traded with XSP and can really say how it is. But I suspect that liquidity might be an issue of getting out of the positions. But I don't really know.
Understand. Thank you. And the next question is that you mentioned that you may take 12 to 13 break-even iron condors in a day. Of course, not all open at the same time. May I know how many iron condors would you have on simultaneously at the maximum that you have tried?
Well, I might at the most have maybe up to 7, 8, 9 open, but I would in that case only have about 4 at the maximum that are open with the full risk. And what I mean by that is that they are kind of at risk of the double stop losses. If I have more than that, there's usually because the others have decayed so much that I can tighten the stop loss on both ends and to, let's say, 0.2, 0.3, 0.4. So the actual risk is much smaller on half of them, to give an example. So I think, I rarely have more than 3, 4 open with the full risk.
So you may have, let's say you may have 8 iron condors on at the same time, but maybe only about 3 or 4 maybe 4 of them already tighten the stop loss such that even if it get hit, you are in a profit.
Yeah, or the limited loss.
Limited loss.
So let's say that example I was mentioning that the market has moved very much in one direction, and let's say the market drops and 4 positions hit the stop loss on the put side. If the market then moves up, in that case, I would try to tighten. I might try to, if it stays down on that level, right, then I might quite soon try to tighten all those stop losses. And maybe if the market move very fast, I can actually tighten those stop losses to mean that on the other side, the max risk is maybe $30, $40, $50. So then I'm feeling I will do that, and then I feel I can enter new positions.
Right, I see. Thank you. And if one side is hit, what do you do with the other side? Do you close out the whole break-even iron condor, or you leave it on and manage it?
No, I leave it on. I leave it on because the idea here is that the other side will expire, right? Worthless. And that's why we call it a break-even. I close it. I close the short. I will set a order for the short to be closed at $5 just to get out of it. But that's it. So I leave it on until the short will hit the $5.
Right. So you want to take the risk, the leg out of the way, lah.
Yeah, I like to do that because I think it's not worth it. It's nice to just in that way. In the end of the day, I'm out of risk mostly.
Understand.
My last positions will typically be closed at 10-15 minutes before, because depending of course, but I'm reducing the risk, and I think it's I prefer to do it that way.
Okay, thank you. And you mentioned that you will keep the trades about 30 minutes apart at least, right? That's quite intensive throughout the day. Do you trade on your desktop computer, or do you use your mobile phone or the trade? Or
I never got very comfortable at opening trades on the mobile. I use my laptop and desktop primarily. I will sometimes use my mobile to adjust stop losses. How intense I trade, of course, depends on my personal program, right? Some evenings I do have a social life. I do meet with people, and I have other stuff. So, of course, in those days, I will just have fewer positions. And in situations like that, I can use the mobile to just adjust some stop losses, but primarily also have fewer positions. But I don't know. I haven't gotten used to opening the trades on the mobile, and so I prefer to do that on the desktop.
right. Thank you. And roughly how much margin is required to trade the one contract or break-even iron condor?
Well, it depends on the width of the spread, and people follow do this differently. I typically have a width of 25 to 35, which means that there will be a margin for that one contract of $2,500 to $3,500. Others have tighter. Others run with tighter widths. So if you run with width of 20, then it will be $2,000. So it depends on the width. But with the width I typically use, it is around $3,000 typically.
Understand. And now for the first break-even iron condor, you mentioned that you will wait a couple of minutes after open, then you enter, correct? So that one is like the one that you would not really want to wait for the SPX to settle because you want to catch the IV crush, is it? While the subsequent iron condors, you will then try to wait for the pause in the SPX price before you enter them. Am I correct to say that?
Yes, I mean the first half hour, 1 hour, the prices of the options typically drop quite significantly because you get lower volatility very quickly. But of course, it's a bit hit or miss because if you enter an iron condor at that time, the market makes a big move, it can also hit the stop loss in very few minutes. I still do it because those positions might sometimes get more than 50% profit in the first hour, and I will sometimes close them then. Or if the market jumps one direction and you hit the stop loss, typically the other side will also lose value quite quickly. So the loss of the risk of the double stop loss is not. At least not bigger than for the other trades in my experience. But I try to, I see that first trade a little bit as a lottery ticket.
I see. Understand. Now for the subsequent iron condors, the second iron condor onwards, you mentioned you want to wait for the SPX to flatten out. How do you determine that the SPX has flattened out? Do you look at a 1 minute chart, or do you use some other tools, or how do you determine that?
No, I'm not very, I'm not very a sophisticated user of advanced technical tools. I typically look at the 5 minutes. I have opened both the 1 minute chart and the 5 minute chart. I typically look at the 5 minute chart, and I think if the market has made a big move in either direction, I will typically wait until the 5 minute chart. You have 2 or hopefully also 3 that are more or less on the same level. It's not more advanced on that I have a feeling that it's stabilized. But also sometimes it's also a benefit of being on have positions on different levels, right? So I do look a little bit at the total delta of my positions too. So if I have a generally negative delta or on several of my positions, and I might appreciate to get in on a level that balances that a bit.
So you seek to be delta neutral?
I think ideally it's good to stay fairly neutral, right? Because this is a market neutral strategy. So I think I will sometimes tilt, like if 4 of my positions would have negative delta and I'm adding one more, market is kind of I might tilt the next one a little bit. Not usually I don't do it, but but by entering on the higher level, then I'm also balancing it out, right?
Right. Understand. Okay, let me see. Now, you mentioned about the width of the break-even iron condor to be between 25 to 35 wide. How do you determine closer to 25 or closer to 35? Is it the premium or something else?
I like number one is that I want to have about the same premium, ideally the same premium on both sides. right? And this is not always so easy to achieve, but I try to have the same premium on one side. So typically how I do it in TOS is that let's say I first click on the put credit spreads, and if that gives me, I try with one 25, 30 WIT, and that gives me a credit of 80, then I will kind of look at the call sides and try the shorts, add the short and long there. That will give the total value of the position 160, right? So then I'm figuring, and then I might actually have to go down to 20 or up to 35 or something on that to get to approximately the same level. So sometimes I don't always have the same width on both sides. I will sometimes adjust to try to achieve equal premium. But as I said, getting the same premium on both sides is tricky because seconds after you're sending your order, market may change, and what looked like equal premium might be filled at not equal premium. So it's a little bit tricky to achieve that.
Right, but to achieve. Sorry, go ahead.
No, and I will sometimes. At least later in the day, I might sometimes, ideally you want to spend as little as possible on the long, right? Because it's there for protection only. But on the other hand, you don't want to use too much of your buying power. So it is a balancing act somehow. And if I have already used, I might also sometimes go down in width just if I have already feel that I've used enough of my buying power, not to add too much buying power.
Right. I see. Now, to achieve the similar credit on both sides, then you will need to simulate the trade as two different credit spreads instead of one iron condor, right? Otherwise, you wouldn't be able to see the premium of each side. Am I correct to say that?
Yeah, I haven't found a good way of doing this in TOS. So essentially, that I do it as I described. I click on each position individually instead of when I open the order. So I first click on the short and the long on the put side, and then I can see the value. Okay, $80, and then I look at the prices on the call side. And I take short and long that should give me 80. And when I've clicked on those, the total value of the position should be around 160. So I don't know. Probably there are better ways of doing this than what I'm doing, but that's how I've been doing it.
I see. So you prioritize having similar credit premium collected over having same width. Am I correct to say that?
Yeah.
Okay, understand. Thank you. Okay, next question. Now, if let's say after you open the iron condor and then straight away, the price move against you such that your P&L have hit your stop loss on one side, do you, say, oh, I'll close that side or something like that? That means you put on the iron condor, and then the next thing you want to do is to put on the stop loss on both sides, right? And then before you could put it on, the market moved so fast that it hit your stop loss before it could be placed. So do you close that side manually?
Well, this is an excellent example of where the rational John will fight very hard with the emotional John. Because the emotional John in such a case will say this will turn around, let me just wait and so on. The rational John knows that you should just get the heck out of this position as soon as you could. And I've had a couple of situations like that where I've actually lost a little bit too much because I was waiting. So there, I think the right thing to do is just close out. And as soon as you can, even though the loss is much bigger than you normally. But of course, I've had I have not followed that rule always, and a couple of times I have lost quite bad on it. A couple of times it has turned around. and ended up with a nice profit. So I think, but I think the rational John should win over the emotional John in this.
Understand. I know what you mean. You know.
But this is what is fascinating with option trading, I think, or trading. I think this kind of trying to this balancing of being sticking to your rules and sticking to what you know should happen, etc. Being disciplined and fighting your emotional. On the other hand, and I think this is why stop loss is so important, is that we automatic stop losses, that you actually take away a lot of this rational, this emotional part by setting on the stop losses. You just made a rational decision. I will get out at that level, and then it just happens.
Yes, I agree.
There are people who argue that who say they follow manual and they have mental stop losses and they will watch and have alerts. But in my experience, I think you will end up in bad situations quite often with zero DTE, because you can do that on longer DTEs, I think, but on zero DTE, the market can move so fast and the gamma really hits you. And what is $50 in plus in 1 minute can actually be $300 or $400 or $500 in minus the next minute. And if you are sitting there and trying to mentally decide when to close out, most of us are not. I don't think we are able to actually make rational and fast enough decisions. So I'm a strong advocate of always putting on automatic stop losses.
Understand. I agree with you, John. I have been through that as well. Hope is not a strategy. Okay, great. Thank you. Okay, next question. I think you might have covered this. I just want to ask you one more time just to make sure. So if let's say both you have the market stop and the stop limit set up as an OCO on each side, right? Okay. So and then you mentioned that in a very small handful of times, both get triggered. And the correct thing to do, the rules or your guideline would be to quickly exit the unnecessary trade quickly.
Yeah.
Okay, got it.
Or I have a couple of. I think also you can. Or what is this trade? You could also, of course, set a trailing stop loss on it, a tight trailing stop loss where it actually. I have done that also, where you actually say that okay, if market keeps moving, the trailing stop loss will follow it, right? So you might actually come out, but you need to handle the position quickly, I think.
Right. Understand. Okay, let me see. You also mentioned that you set the stop loss. Initially you will set it on the spread. Then at some point in the day, you will change it to just setting the stop on the short legs. At what time do you make that decision? Or on what guideline would you use to say, oh, it's time to change from a spread to only on the short?
Well, when I group my trades into these TOS groups, right? So I can so I actually follow the prices, and when the price basically get down to of the long, get down to a spread from 0 to 0.05, where it basically has no value. Then it's time to not include the long in the stop loss. And that typically happens at the last hour, because if you have the spread stop loss, then there is actually no bids for the long, and you might actually get a very bad fill for a spread like that, because there is no bid for the longs, while you get much more quickly out on the shorts. I do that as soon as I see that the level is that they basically have no or very little value. And sometimes at the end of the day, if I open positions towards the end of the day, I will typically just set the stop loss on the short right away, because if there's very low value on the long, I know it's gonna go to zero very quickly. So it's just you get, and there are others who are consistently set on the that's the other strategy on the shorts throughout the day, right? And then you have to just manage the long after the stop loss hits and close it. So that's the alternative way of doing it. I'm just doing a spread because I think it's the easiest way to deal with it for me. But it is also possible to just consistently set on the shorts, and then maybe you need to adjust. But then you need to adjust the short level to include the estimated value of the long, and that just makes it more complicated for me.
I see. Understand. Okay. Now the next question I have is how do you use the 0DTE SPX.com website? You shared in a slide that.
Yeah, I think I explained that I'm particularly following this black line of that is summarizing all the out of the money option prices on both the call and put side. So it's like an index of the prices of the options, the different strikes at that moment. And it will typically start very high and then will drop continuously throughout the day. And this line will, of course, end up in zero every day. And I think it's a good tool to indicate, because sometimes you might actually see increased volatility, even though the prices are flat. And for some reason, the volatility keeps going up. Even though the VIX may not go up, because the VIX is on a longer perspective, right?
Mm-hmm.
So I think that data is quite interesting to see that when that happens, because in the end of the day it will turn around this indicator. So I sometimes think that if it makes a good jump up, and let's say the price of SPX is staying stable, it might be a good time to enter a new position, because then you benefit from when the IV drops again.
I see. So you turn on the black line, which is showing the out of the money option pricing, and then if it spikes up, you notice a spike, then that's when you will like consider an opportunity to add.
Sometimes I will do like that, and we talked about the FOMC days, and on those days, or where there are news, you will also see how this actually stays flat, even it's not decaying. And so it shows basically the total theta decay at that moment, how that develops. And I think that's useful data to have.
Right. Understand. Thank you. Now, let me move on to the question. Now, we time check. There's about 20 minutes left to 9:30. And are you still okay to continue?
Yeah, sure.
Okay, great. So we'll see how much more questions we can cover from the attendees. Now, let me see. Yeah. Okay, Martinez is asking, do you adjust your strategy based on the VIX levels, like when VIX is low or when VIX is high, or you don't?
No, I don't really, except when VIX is low, you generally ends up closer to positions closer to in the money, right? And when VIX is very high, I can sometimes sell on lower debt delta and get the same premium. So I will often tend to maybe sell on lower deltas when VIX is high, because I get the same premium for positions even further out. But I don't have any consistent way of adjusting according to VIX.
Understand. Thank you. And Bobby is asking, would you avoid putting on new iron condors at the same strike of an existing iron condor?
I do sometimes, but I prefer not to, because it's just easier to mentally have the overview for the positions if they are all on different strikes. But I will sometimes. Sometimes you really don't have the option, right, to the choice. You have kind of filled up the strikes. So then I will actually enter a new one on the same and just try to. But I try to avoid it, because it's just to make life easier.
I see. And do you encounter when you try to put on the new iron condor where the long leg is the short leg of a existing iron condor?
That I try really to avoid.
Okay.
I shouldn't, because that just messes up the full overview. It does happen every now and then that I am mentally overlooked, and it happens. But then I always have to kind of figure out, what happened here. So I really try to I know it is my rule not to have the long not to have the long overlap short. So the few times this has happened, it is because I somehow overlooked it when I was making the trade.
Right, understand. So it sounds like to me that you want every iron condor's legs to be standalone in that strike price. So
It's the easiest, but as I said, I do sometimes have overlapping shorts. Overlapping longs doesn't matter, right? But I do have overlapping shorts, and then I just have to figure out how to do with the stop losses.
I see.
Sometimes if I do that, I just make the same position as I already had, same short, same long, and then I can just adjust the short stop loss. That's if they are on more or less the same level, that happens. Then I can just adjust the stop loss to be for 2 contracts instead of 1.
Understand. Okay, Bobby, I hope that answers your question. Let me move on to the next one. Just give me a minute to see. Okay. Arun is asking, do you use the template for TOS when you place your OCO order?
No, but I should.
Okay.
And I'm really planning to set up templates for that, because actually setting up and adjusting the stop losses, it takes time. So but I haven't really had the time and to really figure out all those templates and how I can make them. But I really should, because it will save me time.
Understand. Now, there are a few questions regarding other symbols for a smaller account, like trading SPY or using ES or MES instead. Would you have any comments on using these other symbols?
I don't really have any experience with them. I never traded the ES futures at all. I have traded SPI in other strategies, and SPI is very liquid. I'm sure you actually could do it with SPI, but I think the assignment risk should be considered with that, because it's you don't want to be assigned shares really, and so this is the part that I would be a little concerned about. But I have never tried to trade this strategy with SPY. I was asked about XSP, and of course XSP would be ideal because it's also cash settle as far as I know. But I guess it's less liquid than both SPY and SPX. And liquidity is important, right? I think I tried not this, but a couple of other strategies on NDX, which is the Nasdaq similar options product. And after just a couple of trades, I gave up because I realized NDX does not have the liquidity there. It's nothing near, right? And I was actually not able to get out of positions on the stop loss because of lack of liquidity. So liquidity is a big concern maybe. But I do not have the experience of doing this strategy with the other products. I would just stuck to the SPX, but I see the benefit, of course, if you have a smaller account of. It can be a little bit, it can be a little bit too big.
Understand. Okay, thank you. And let me see. Shank is asking, would you mind sharing which broker or platform you typically use? From my understanding, is Think or Swim from TD Ameritrade. Am I right?
Yeah, that's right. It's the only one I use.
Yeah. Okay, Shank, I hope that answers your question. There are a number of questions regarding whether you use charts. So just now you mentioned you use a 5-minute chart, and just to look for price stability for maybe 2 to 3 candles before you place the next trade, assuming it's at least half an hour apart. That's about it that you use, right? Do you use any other things other than that, and maybe the 0DTE SPX website?
No, I have to basically look what I have on this chart, but I have one specialized, one I could have one setup on. I don't know if I can share it, but I do have one setup which shows the volume. I don't think it shows the SPX 1 minute. It has this ADSPD that shows the number of tickers going up and down. It has the ticks, the VIX, and the volume also. But I'm not very advanced in technical analysis. So basically, primarily, I'm looking at the SPX 1 and 5 minute graphs and this 0DTSPX.com.
Right. Understand. Okay, I hope that answers the questions of several of you who are asking about chart setup and technical analysis. John used very little of it. Okay, thank you, John. Let me see. There's a question here by JL. He or she wrote that when he tries to place a bull or call spread, delta 5 with a spread width of 40, he or she only gets about 50 cents worth of premium. So how do you get $2.10 worth of premium?
The example I was using. He or she is mentioning the specific example I was using. Yeah.
He or she is saying that in the past few days, when he or she tried to put on a delta 5 spread width of 40, the premium that he or she gets is only 50 to 60 cents. So how do you get $2.10?
Yes. With the current market with very low VIX, you might struggle to get a very high premium on 5 delta. The example I used in my slides was one I just made up or just took outside market hours on Monday, and when I was preparing the slides, just to take an example. So it's probably not necessarily very realistic prices in that example. It was just to show an example. I don't know what delta that was either in that example. I just wanted to show an example. But it is right. When VIX is low like this, you do probably usually need to get up more than 5 delta to get. I try to keep things between $100 and $200 per iron condor per contract, and you need typically to get up at least 7, 8, 9 these days to get in that level.
Right. So we'll have to move to higher delta.
Yeah, you do. And when VIX goes up, you can have a lower data.
Okay. Thank you, John. JL, I hope that answers your question. Another question from JL is this. He or she says that if we set cut loss level at about 0.05 above the premium collected, wouldn't the cut loss be very easily triggered?
Yes, as this strategy has 60% losses, right? And this is uncomfortable for many that you have, and this is that you have to actually, most of your trades will be losses. I do have another strategy that I'm usually putting one or two trades a day on another one. That is actually where I have the 3x stop loss. Where you will win. So if I collect, I will go for around 100 in premium, and the stop loss on each side will be set at not 3x, 1.5. It will be set at 1.5 for 150 on each side. So you will lose. If one. You will lose $50 if one N is going on the stop loss. So this one, of course, the stop loss will trigger less, but actually the profitability is also less on this strategy. So I think that Tammy Chambers have been doing a number of back testing on this, and I would search up her in the Tasty Trade options group, because she's been doing a number of them and compared different stop loss level and concluded that this very tight stop loss, yes, it loses more often, but the expectancy is still higher actually than wider stop losses.
I see.
So you have to, it all depends. It all boils down to what is the average win that you have with the strategy, what is the size of the win, what is the average loss, and what is your win percent. And out of that, you can make the expectancy. And if, of course, with the wider out stop loss, you will have a higher win percent. But this relationship between the average win and the average loss will also be different. So you might end up still with a lower expectancy.
Understand. Thank you, John. And Gio, I hope that answers your question. Yes. Okay, John, I've come to that was the last question that we have for you.
Okay.
So thank you so much. I think we have kept it well within the 2 hours, with 10 minutes to spare. So thank you so much for your time and your generosity in putting together the slides and also this sharing in this webinar. I believe many people will benefit from the video that they will be able to watch moving forward on YouTube, to just like Tammy's video, to benefit from your sharing about your break-even iron condors in SPX. And for those of you who have been asking whether there's a recording of this video, the answer is yes. It will be on Wealth and Joy's YouTube channel. So if you just go to Wealth and Joy YouTube channel, you'll be able to watch it there. And if you have benefited from today's session, please subscribe to Wealth and Joy YouTube channel so that you can be notified of future videos directly from YouTube. And if you would like to read up on the strategy that John has shared and he has written on his website at sandvand.net. That's his last name, right? Sandvand.net.
Yes.
And then he has written several articles on this break-even iron condor that he is trading. Now, and John, once again, thank you so much for your time. And do you have any last few words of wisdom to share with our attendees?
Not words of wisdom, I think, but I would like to say thank you for inviting me. It's a privilege, I think, and and I like to be able to both share and get the knowledge from others. So it was a great experience to present to you and answer all your questions. So thank you very much to all of you.
Thank you, John. And everyone, that's all for tonight's webinar. And I wish you a very happy Easter weekend. Happy holidays, John.
Thank you. Same to you.
Thank you. And same for everyone who are here tonight. And I'll see you at the next webinar. Goodbye and good night. Or good morning.